Well, good afternoon, everybody. I know we're waiting on some audio for some people, but we can go ahead and get started. So we are very lucky to have Duke Cunningham here today with TrustPoint. He's a certified financial planner, and he has some information for us about financial peace of mind and how to plan through all of this COVID stuff. So just before I turn it over to Duke, just a few quick chamber announcements. I'm going to go ahead and share my screen here. So I'm sure many of you, or probably all of you, have been on our main chamber COVID webpage. And just to point out a couple of the really important things that have happened in the last couple of days. So Badger Bounce Back is kind of the big buzzword right now floating around. So you can go and find this Badger Bounce Back document on our website. And I would suggest the most important thing to look at really to help get us through answering a few questions as we move forward here is the gating criteria. So you'll hear a lot about gating criteria in order for us to move businesses into phase 1, phase 2, and phase 3 of kind of turning that dial back up. And it's based on symptoms with downward trajectories, cases, and then hospitals, and how hospitals are prepared with their numbers of beds and things like that. So there's a bit more specificity, but I definitely wanted to point to the Badger Bounce Back doc. There are 6 pages in the full document or that are outlined. And then at the bottom for businesses is a chart kind of talking about how we move through phases. And then there's also a quick 2-pager that might be helpful as well. So I also want to point to our remaining 2 webinars this week. So tomorrow we have TJ Brooks, who often does the economic indicators breakfast. For us, he is a professor at UWL in econ and finance. So he'll talk to us about what's going on in our local economy. And then on Thursday, we have Ed Jekyll from JRM CPAs talking about helping us understand the Paycheck Protection Program, or the PPP. So to see prior webinars from the last couple of weeks, or to sign up for or register for these, you can go to the Chamber Chat section of our webpage. So again, I want to thank you for joining us, and I want to turn it over to Duke. Duke is ready to share a whole bunch of information, and at the end he will take questions. So go ahead, Duke.
Sorry about that, I was still muted. So thank you for attending, and I'm just going to get my slide ready to share. Go from there. So, all right. So I appreciate the introduction there. Look forward to chatting with you about everything that's kind of been going on and things that you can consider or should do in these types of environments, especially the COVID-19 one that we're living in right now. So what I'll do is cover a bunch of material, and then as they alluded to, we'll have some questions and answer at the end. That works best. So what to do in a down market, just kind of the financial checkup, is stay positive and connected. You know, there is a lot going on right now, so I would really encourage that you stay positive though, and use your resources that are available to you. So stay connected with them, and stay connected with your peers and colleagues and family most of all. So again, you know, if you have a positive outlook, you can kind of lessen the impact what this means to you personally a little bit. But from a financial setup, we're going to do a financial checkup, for lack of better words. We're going to talk about what you should be thinking or what you should be doing with regards to investments. Maybe having to look at your budget spending, revisit your financial plan, and then some specific planning options that may be opportunistic in an environment that we're going through. Additionally, I'd like to touch on a review of your estate plan, the recovery rebate checks. Maybe some of you have received them, maybe some of them you haven't, but I'll touch briefly on that. And then just some tips to consider that may be useful if, you know, someone you know or someone in your household is experiencing you know, lost wages, furloughed, or laid off. So we have some nice touch points with that. So what to do in a down market? The biggest thing I think you should do is tune out the noise. Listening to the news day in and day out it can be really overwhelming because there's so much information, some good, some bad, some to the extremes, really trying to kind of create the shock and awe effect. So I guess what I'm encouraging you to do is really not to read and watch the markets day in and day out. Trust your advisors to be doing that for you. It's okay not to check balances. I didn't even look at my first quarter retirement plan statement just because I knew it was going to be painful, and it's not going to do anything but add stress or anxiety to my situation. So I chose not to look at any of those statements, and that's perfectly fine. Doesn't mean you don't ever want to look at them, but you want to be mindful of that. Remember your asset allocation. So when, again, you look at the market and you see these huge gyrations, up 4 or 5%, down 4 or 5%, and you see these huge numbers, but again, focus on the percentages. But remember, that's all stocks. I would speculate many of you have a mix of stocks and bonds in your portfolios, whether it's in your 401k, IRA, or a brokerage account. And be mindful that, that's why you diversify and have different assets in there, such as stocks and bonds and different types of stocks or bonds or mutual funds, to help mitigate and reduce the risk that we use versus what you see in the S&P 500 or the Dow Industrial Index and other indexes like that. But remember, you have that asset allocation, and again, times like this, it's a good time to revisit that to make sure your asset allocation is in line with your goals and plans. I would really advise you to stay the course. That is the best piece of advice I think we can give you as financial advisors or financial planners. I worked at TrustPoint in 08 and 09 in the investment team and ran our trade desk through 08 and 09, and we held a lot of hands during that time. And again, most of the clients stayed the course. They realize that they don't need all of these funds today, tomorrow, or next week, that they need these funds working for them for the long term, because the market does correct. It does have some tough points, and you're going to want to make sure that you stay the course, because if you fail or can't resist the urge to sell out, likely you're going to sell out and lock in all of those losses and miss out on the recovery. Just looking at the market right now, year to date, the S&P is down 14%, or prior to today's market. And that's, at one point we were down, from the high to low was down 35%. We've recovered a lot of that. Now we still have a ways to go, and we're not going to go straight up from here either. But that's why it's important to stay the course and resist the urge to sell out of the market. And one of the things that can help you with staying the course is revisiting your financial plan. Your financial plan should highlight your goals and objectives and identify the risk tolerance and your palatability for risk that you can withstand in markets like this. The other part you want to do is review your budget. If you're thinking about maybe turning back your contribution rates, or you've lost some income, the easiest thing to do is dissect your budget and spending. Identify your expenses as fixed versus discretionary, or needs versus wants. And I think of that as paying your mortgage or rent versus maybe a gym membership versus, a charter or a cable bill or a cell phone bill. Cutting back and reducing some of those expenses can really help your cash flow. And the easiest way to do that is look at your bank statements and or credit card statements. So a lot of the credit card statements have neat tools out there where you can kind of assess and align where you're spending, and then make changes, or see what you can do to improve your cash flow or the ability to save. I think it's important to consider adding, and bumping up your contribution rate. When you're adding to the market or investing in the market right now, you're getting things significantly discounted. It's like going into a retailer and finding the jeans you want that are 25% off. That's really where you're buying some of these investments at. Sometimes more, sometimes less, depending on the nature of the investment. The other option with regards to your budgeting is make sure you check with your financial institutions. If you have been impacted directly by the COVID-19 or coronavirus, there may be some options for you with deferring payments. Maybe it's interest only, or some of your student loans, I think, are clicking off interest for a short period of time. But again, you're going to want to reach out to your specific institution for better advice on what options may be. And I'll cover that further on too. But ultimately is put a plan into place And then even if you're just doing it temporarily, so maybe you're increasing what you're putting in the plan, or you're decreasing what you're contributing to your savings or retirement account, but be mindful that this isn't a permanent change, that you want to maybe set this as temporary and then revisit it again in 3 or 6 months, just to make sure you're adjusting to the circumstances that are out there. I always believe, and every financial planner you talk to is going to say, that you should have at least 3 to 6 months of expenses built up in cash. So that's at a savings account at your bank, preferably not in a checking account, something that's not as accessible. That's very important to have that built up. And then these are the times of why having those expenses built up in your savings account is key. So you don't have to maybe put it on credit, or you don't have to miss a payment if your hours are cut back from 40 to 20 or 30. You can rely a little bit on your savings to help offset some of those expenses for temporary needs. But the biggest, I think, positive of this is looking at contributing to your Roth or your IRAs or 401ks. I really advocate for Roth, especially after what was passed in 2019 with the Secure Act. But you can still contribute to your Roth or your IRA for 2019 calendar year, since taxes have been extended out to July 15th. Like I mentioned earlier, consider increasing your deferral rate in your 401k. It's a good time. I've had a lot of conversations with participants that we work with, and they've actually increased their contribution rate to the plan. And I've talked a lot of those folks into thinking about Roth or considering Roth, because all of your earnings on the Roth are tax-free. Outside of a retirement plan, right now you can contribute $6,000 to an IRA, whether it's Roth or traditional. And if you happen to be over 50, you can add another $1,000 on top of that. Tax loss harvesting. So this isn't applicable to everybody, but if you have inherited some assets, or you have a taxable brokerage account between you and your partner, or just in your own name, this isn't an IRA, this isn't a Roth IRA or retirement plan. This is a taxable account where you pay tax on capital gains, interest, dividends earned in that account. However, with these types of market corrections, there's often a good opportunity to sell some of those investments at a loss, to realize those losses, because going forward in future years you're going to have gains, and those losses can offset the capital gains tax that you may have to pay. The other thing is if you realize losses and you don't need them this year, you can carry them forward. So again, something you may want to talk to your CPA or whoever is doing your taxes to kind of think about, does this strategy make sense for you with respects to harvesting losses. It can also help reduce the concentration of stock. So say you were gifted a large percentage of Wells Fargo stock, and the base is as low. So if you were to sell out of it, you're going to be paying all the gain, all of that appreciation. You're going to pick that up as capital for capital gains tax. Now that the market has been cut back a ways, or certain stocks have been cut back more than others, maybe it makes sense to reduce that position, realize those gains, but at a lesser rate. But be mindful that when you are selling these investments, that you should reinvest them into a portfolio that makes sense with your goals. So you're not just going to cash, you're simply realizing the gains in those particular securities and reinvesting those proceeds into an area that makes sense with your portfolio. I can't stress that enough. If you do loss harvesting, you want to make sure that you're putting those monies back to work. Another big opportunity right now is Roth conversion. That's why we have a full slide to it. Take advantage of this down market. You can actually move more money, I'm thinking, inside of a 401k plan or an IRA, because the accounts as a whole are down. You are actually, if you do a Roth conversion, say 10, 20, 50,000, whatever the amount that works best for your situation, you're actually moving a greater percentage of the account today, because when you get the recovery in those assets, they're now going to be tax-free in the Roth, and it's going to work out better for you long term. It clearly outweighs the immediate income tax costs. So whenever you do a Roth conversion, you want to be mindful of having outside resources, outside cash, to assist with your tax payments that are going to result from the Roth conversion. So if I make a $10,000 Roth conversion this year, what I'm doing is essentially taking a distribution from my IRA and rolling it into my Roth IRA. So I pick up that $10,000 as ordinary income for my 2020 taxes. So you'd want to make sure in for April of next year, 2021, you have some cash allocated to account for that Roth conversion. And why is this really important right now? In December of 2019, the Secure Act was passed, and that changed a lot of changed really how IRA beneficiaries are treated. Spouses, disabled beneficiaries, they have similar options to what they had before. But I think of children and other individuals that may be a beneficiary to an IRA. They no longer have the ability to stretch their distributions over their lifetime. They're restricted to having to distribute out the IRA, inherited IRA, within 10 years from the time they inherited it. So for example, I think of a husband, wife, they have $400,000 in IRA, pre-tax IRA money, and the surviving spouse passes and they want to leave their two children 50% of the IRA. So one child inherits 200,000, the other child inherits 200,000. They're required to distribute that $200,000 out within 10 years. So essentially adding $200,000 of taxable income over that 10 years to their situation, and maybe even some growth in there depending on how you invest it. So it's really pertinent to think about Roth and converting to Roth and investing or utilizing Roth in your retirement plans. The other situation is with all of this, the stimulus and the low tax-free environment we're in today, it's very probable when we're retired and needing to draw from these assets, tax rates will be much higher. So again, having Roth, being able to take tax-free distributions and enjoying tax-free growth could add a lot of value to your overall financial situation when retirement comes. I'll touch briefly on this. I'm not going to go into grave detail on here, but this is still a time I've had a lot of folks reach out and want to be charitable and help out organizations, non-for-profits. And obviously when Congress was going through the whole CARES Act, they thought that would be a good opportunity for folks or individuals that are less impacted to help out those organizations that may be where their funds may be drying up. So with the CARES Act, if you aren't itemizing and you are charitably inclined, you can take a $300 above the line deduction for those gifts. However, if you do itemize, right now the CARES Act suspends the 2020 AGI limitations for qualifying cash donations made to public charities. So again, if you are making those gifts or have a large gifting strategy, maybe you want to gift some appreciated securities. So I think of those, that highly appreciated Wells Fargo stock or that highly appreciated Fastenal stock. Maybe now is the time to consider gifting those as well. It's a little bit different than the AGI limitation cash donations, but still it could be a good time to maybe gift in kind, to gift those depreciated assets. Qualified charitable distributions are still in place, even though the 2020 required minimum distributions have been suspended. You can still make qualified charitable distributions from your IRA if you're over the age 70 and a half. And why is this nice? Is because you don't pick up income in doing so, nor do you have to worry about claiming a deduction. It's a really nice way and efficient way to be charitably inclined. You just have to make sure that you contact the trustee of your IRA, ask them for the distribution, and make sure that they make the distribution directly to the qualified public charity. And then it will benefit you in the way that I've described. If you have to be careful, you don't want to send it to donor advised funds or supporting orgs, as those aren't recognized as public charities that would benefit from the qualified charitable distributions. And then if you're simply thinking about helping out family or a friend or some situation, the annual exclusion rate is $15,000 per individual. So I myself could give a colleague who was struggling $10,000 if they needed some funds because of being negatively impacted by COVID or any situation, and they're not going to be impacted negatively, nor am I going to have to worry about any other tax ramifications from doing so. So that is what the charitable side. Review of your estate plan. Obviously, there's folks that maybe have more time right now because they're home or they've been furloughed or just this everything that's going on with the world right now makes you think about it. Do I have all my I's dotted and T's crossed? And having your estate plan together and sound and up to date is paramount. So what I would suggest is pulling out the will or the revocable trust that you have, read through it, make sure there haven't been significant life changes to your situation. If there have, I would strongly recommend that you reach out to your estate planning attorney and have he or she have a discussion with you on maybe some updates or changes you should make. It's really important because you can build and save money, but if you don't have an estate plan to manage your estate when you pass, there could be some unnecessary consequences, both from a tax or financial cost. When you're doing that, if you do have a revocable trust, you're going to want to make sure that you have your assets titled properly. Think of your home, your checking accounts, a joint or individual brokerage account. You're going to want to make sure they're titled appropriately underneath your revocable trust. Essentially what the revocable trust does is it acts as a fishing net and scoops up all of the assets that are part of the revocable trust. Now, you're not going to do this with your retirement accounts. You're not going to do this typically with life insurance. You're not oftentimes making your revocable trust the beneficiary. Oftentimes you're naming it to individuals, family members, spouse, things like that. So that's where you want to verify your beneficiary designations for IRAs, 401ks, life insurance, and beneficiary designated accounts. Verify your financial power of attorney, because if you aren't able to make decisions, who's on docket to make those decisions for you? Oftentimes it's a spouse, but you may want to revisit who you have for that backup and see if he or she is able to act on your behalf. And lastly, because of everything we're going through, and just recently being in the hospital, my wife gave birth to a child on April 3rd. There's limited access who can be at the hospital. So being mindful of your healthcare directives can really assist families in tough times, especially like these. It's always tough, but in events like this, having your estate plan in order, in particular your healthcare directives, could be paramount. And that means looking at who is your healthcare power of attorney, your advanced directives, living will, things like that. And again, some of that your estate planning attorney can help you with, and some of that you can go right to Gunderson or Mayo's website and get the advanced directives or living will completed right online with their help. Additionally, I want to talk briefly on the recovery rebate checks. I'm assuming some people have gotten theirs, maybe some are still in the way. Again, most of these are digital or coming electronic via ACH, although some folks are going to get paper checks, which I know those are a little bit delayed yet. But this was part of the CARES Act that was passed at the end of March. It was a one-time cash payment of $1,200 to those individuals, and with income phasing out at about $75,000. And then it's a one-time cash payment for those filing married and filing jointly of $2,400 with income phase out starting at $150,000. Additionally, you may have qualified for another $500 if you have a child that you can claim that's under the age of 17 or 17 and under. So again, those checks should be coming electronically. Be careful of phishing and email scams, because the IRS, they aren't reaching out to you asking you for information. It's based off of your 2018 or 2019 tax return, whichever one you had filed last. So just be mindful that there's some ill will people out there that are trying to fish and scam to get their hands on those monies. So just be mindful that you aren't going to get a call asking for your bank information, nor an email asking for your bank information where they should route it to. They're basing it off of your 2018 or 2019 tax returns. If you did direct deposit, that's how you're going to get the funds. Or if you mailed in your taxes and mailed in your payments, then you're likely to get a paper check, and that's just going to be delayed a little bit. So what should you do with these rebates, recovery rebate checks? Is, I think one thing is what a lot of folks, I'm sure they've had to dip into the emergency fund. It's a great place to go park those funds. As this COVID-19 situation and the safer at home events and things like that continue on, there may be an additional need for those funds. So that would be my suggestion initially if you've had to draw from your emergency fund is to replenish it. Maybe it means paying off debt or paying down debt. I would suggest if you have a higher interest rate credit card, it may make sense to pay that down or pay it off. If you are doing well and don't have a specific need for those cash and your emergency fund is built up, maybe it's time to look at investing and put them in the market. The market's still going to be challenging for the foreseeable weeks and months. However, I do honestly believe that 12, 18 months from now, when you look back, you're going to be happy you made that investment if that's the choice you go with. Obviously, it's the primary purpose of these recovery rebates is to help those that lost income. So using it for that purpose. If you are using it for lost income, what I would suggest is maybe allocating it over 2 or 3 months so you don't necessarily use it all up up front. So maybe you allocate $600 for the month of April and $600 for the month of May. Again, it'll help you be mindful of where you're spending and help you kind of rein in those budget needs. All right, so these next few slides are going to be tips for lost income or wages. We put this together and have it available on our website, but really, it's a tough situation for those that have been furloughed, laid off, businesses have closed doors, etc. So these are things to consider if those impact you directly or someone you know. Obviously, the first thing you want to do is apply for unemployment, so check with your workforce development in your state. And you're going to need to have some information with that, years of experience or your work detail or work information, and be ready to answer some of those questions. On top of that, you may qualify for an additional $600 in unemployment benefits from the federal government. That's part of the CARES Act. It's a really nice kicker. It's only, I think, good for up to 4 months. Whereas unemployment benefits from the state have been extended out to 39 months, if I remember correctly. So a little bit of difference there, but something to be mindful of, that $600, you may qualify for that. Know your healthcare options, because obviously if you're laid off or you've been furloughed or the business is closed, what are your options with regards to healthcare? So maybe you can talk to your human resource team, or even research out the Affordable Care Act platform or the marketplace, just to see what options, what costs are. There are different insurance firms in the La Crosse area that can certainly assist that if you have been laid off and then don't have any resources available at your former place of employment. But again, I stress this, and as some of you maybe have seen in our 14 tips in 14 days, is just be aware of these phishing email and money scams. Again, be careful. Know the sources of emails before clicking on links or downloading attachments. There's a lot of people trying to prey on those that have maybe are a little bit more vulnerable right now because of circumstances related to COVID-19. So again, just be careful with that, and know who you're talking to and who you're working with. I talked about reviewing your budget and spending. Again, look at your bank and credit card statements. That's the easiest place to find where your money is going. Sometimes you have those hidden automatic payments that you forget about. Maybe it's the satellite radio subscription, or it's things like that maybe you don't need to have right now. You can always turn it back on down the road. But something to be mindful of that can help you temporarily with your cash flow. If you shave off 3 or 4 of those, maybe all of a sudden you clear up an extra $50 to $100 a month. That's real money in times like this. Something else that I've heard these more on the national level, that there's certain auto insurance companies that are looking at issuing some rebates back to their clients. So it even is checking with some of the firms that you work with to see if they're doing anything to assist with with folks that are being negatively impacted by the COVID-19 situation that we're all dealing with. Obviously, loans and mortgages, I would check there. If you've been impacted in different places, there's forbearance agreements that allow you to defer payments for several months. Some places are even maybe reducing or having interest waivers to help keep the cost of the debt down for you. But again, you're going to want to reach out to those entities directly I think of mortgages, talk to your financial institution, student loans, credit cards. You're going to want to reach out to those firms directly to see what you may qualify for, because a lot of these companies are trying to be helpful to their clients. Fortunately, it looks like the calls and those issues are starting to trend down a little bit as we kind of hopefully flatten this curve, this COVID-19 curve. Other areas, and I list this last because I think it's the last area you want to touch, but the CARES Act has allowed or made some options more accessible with regards to your retirement plan or IRA. If you're talking about your retirement plan, so 401k, 403b, there are a bunch of allowances and changes that have been agreed upon in the CARES Act, but your plan still has to approve or amend to allow those hardship distributions and loans. So you're going to want to check with the plan administrator to see if if the plan has adopted these changes, because you may qualify for certain hardship loans or distributions that you normally wouldn't be able to. Secondly, you want to see if you do qualify, and to be a qualified individual, you have to test positive for COVID-19. Your spouse or dependent has to have tested positive for COVID-19, or you as an individual have been negatively impacted because of COVID-19. So furloughed, lost work, lost wages, events like that. You'd have to check with your employer to see what those qualifications are, but just generally you have to qualify in order to benefit from some of these hardship distributions or loans from your plan. And additionally, with IRAs, if you were to take a distribution pre-59.5, there's a 10% early withdrawal penalty. That has been waived temporarily for folks that qualify and need these hardship distributions. Again, I would really try to caution you from drawing or taking distributions from your retirement plan at all costs possible, as these assets are long-term and they really need to be working for you and growing. So when you do retire and need to draw on them, they're there for you and can provide the retirement that you're looking forward to. I understand times are tough, but again, just try to use this as a case of last resort. Another option that I've heard some folks using and read about is, if they've used up their emergency funds, is maybe using a home equity line of credit. So talking to your banker where your mortgage is at, or just talking to a banker that you want to work with, and see if you can qualify for a home equity line of credit and maybe use those funds to help help with the lost wages that you're experiencing currently. So in summary, what I would suggest is just remember to stay positive, take care of yourself, both physically and mentally. Again, that helps take away the anxiety and stress of what you may be going through. Fit in those hobbies that have been put off, write down your goals, and make sure you hold yourself to them. And with regards to the investments, remember, it isn't market timing, but it's the time invested in the market. So staying the course, keeping your money working for you is going to benefit you more than liquidating those funds right now. And then reach out to your resources that are available to help. TrustPoint Inc., you can see our link down there, News and Insights. We update that daily with market updates, but we're regularly putting up planning and different legislation and laws that may be coming down from the COVID-19. So you may want to check that resource or use your advisor, whoever is out there, but rely on your resources during these tough times. You're not in it alone. That's what I think my final takeaway is. So with that being said, are there any questions that I can answer for anybody?
If you have any questions, feel free to write them in the chat, or you can also, there are not a tremendous amount of people on the call, so you could go ahead and unmute yourself. While other people might be formulating questions, a question in general for the average person who might not have a great deal of investment or a great deal of wealth, what are the average things to know for prepping for 2020 tax prep?
for 2020 tax prep is, so you're talking with, say, an average middle-aged person who doesn't have the ultimate wealth.
Yeah.
With regards to tax planning, is you can go out, you can continue to invest. Obviously, keeping in mind that you maybe want to make contributions to your IRAs. And this is for 2020 and 2019. So thinking that the tax dates were extended to July 15th, and so have the dates for which you can make contributions to your retirement account, your IRAs and Roths. So that might be something that will allow you to put more money to work in 2020 and benefit you on your 2019 taxes as well as your 2020 taxes. But really the tax loss harvesting is something that could be beneficial with respects to offsetting future capital gains.
Sounds good. And outside of all of the advice that you just gave, do you have any additional advice for people who are very close to retirement?
Very close to retirement, you should be talking very closely with your advisor, your financial planner, because there's going to be a lot of panic. But remember that markets do recover. As I mentioned before, the market from peak to trough was down 35%. Now that amount is only down 18%. I shouldn't say only, still painful, but it's important to remember that markets go up and they go down, and staying the course and not letting your emotions dictate how you should be invested as you near or enter retirement.
So I'll put out a last call for questions. So first, Duke, a very big thank you for taking time out of your day to share some information with us. And second, congratulations on the new baby. I hope that everyone is happy and healthy and that you're all home safely. So with that, thanks so much for your help. We're really grateful.
Thank you. And I think it's great that the Chamber is putting on all these webinars. I've watched a couple of them online in past tense, and I think it's a timely and important topic. So you guys are doing a great job keeping everybody connected. I like the emails that I get daily. Sounds
great. There's a big team of people working on those, led by Vicki, of course. So thanks for that. We appreciate the feedback. All right, everybody, have a great day.
Thank you.